Welcome back to the channel. If SMCI is able to hold above $30.15 by the closing bell, it would represent the first higher low on the weekly chart in several months. From a technical perspective, that would be an important development, suggesting that the long and painful bottoming process may finally be approaching its later stages, rather than continuing to deteriorate. Much of the popular narrative surrounding Supermicro centers on a simplified view of the company as a direct beneficiary of NVIDIA's AI chip dominance. The assumption is straightforward. More NVIDIA chips translate into more AI servers, and therefore more revenue for Supermicro. While the relationship with NVIDIA is real, the underlying business dynamics are significantly more complex. Supermicro is in the midst of a difficult transition, moving from a high-margin specialty manufacturer to a high-volume, industrial-scale operator. That shift brings execution risk, margin pressure, and operational strain that are often overlooked in surface-level analysis. This week, the company confirmed that it is fully prepared to support the next-generation Vera Rubin and HGX Rubin platforms. This confirmation is meaningful. It demonstrates that despite the administrative and accounting challenges that have dominated headlines over the past year, the engineering and product development pipeline continues to advance at full speed. For investors focused on hardware cycles rather than diversified robo-advisory products or broad ETFs, maintaining time-to-market leadership under regulatory scrutiny reflects a notable degree of corporate resilience. From a market activity standpoint, intraday volume is running at approximately 28 million shares, slightly above the 30-day average. This suggests that current price action is not the result of low-conviction drifting, but rather reflects genuine liquidity moving through individual brokerage accounts. The stock opened at $305 and reached an early high of $30.46 before settling into its current range. Bid-ask spreads have narrowed materially compared to the volatility seen in December, indicating that market makers are beginning to converge on a short-term valuation range. Unlike the steady and predictable behavior of stocks such as Apple, SMCI remains a contested name, with buyers and sellers actively challenging price levels. The recent $2 billion credit facility from JP Morgan was initially expected to act as a strong bullish catalyst. Instead, the market has interpreted the financing more as a measure to stabilize operations, rather than as a signal of imminent growth. That perception is unlikely to change until revenue performance begins to align with the company's ambitious $36 billion guidance for fiscal 2026. Until then, capital injections are being treated as defensive rather than transformative. Margin pressure remains one of the most critical points of concern. In the most recent quarterly report, gross margin declined to 9.3%, a sharp contrast to the approximately 17% levels the company once achieved. The assumption that scale would preserve margins has not held. Dell Technologies has aggressively re-entered the AI server market, initiating a price war to regain share. In response, Supermicro appears to be prioritizing market position over near-term profitability, effectively sacrificing margin today in an effort to secure long-term data center dominance. A central pillar of that strategy is direct liquid cooling, or DLC. As AI chips generate increasing heat, traditional air cooling solutions are becoming insufficient. Supermicro has stated that more than 30% of new data centers will require liquid cooling within the year, and the company positions itself as a leading provider in this space. This phase of the industry can be characterized as a land grab, where early infrastructure decisions may define long-term winners. Operationally, Supermicro's business model is built around a modular building block architecture. This allows the company to design and deploy new server configurations in a matter of weeks, compared with the months often required by competitors such as HP or Dell. This agility explains why Supermicro is frequently among the first to ship systems incorporating the latest NVIDIA or AMD silicon. However, this approach is highly capital-intensive. To support rapid deployment, the company carries substantial inventory, reported at over $5.7 billion. That inventory provides flexibility when demand is strong, but it also represents a significant risk if the pace of AI infrastructure spending slows. The primary downside risk for shareholders lies in a potential pullback in AI capital expenditures by hyperscalers such as Amazon or Meta. In such a scenario, Supermicro could be left holding billions of dollars in hardware that depreciates quickly, putting additional pressure on both margins and balance sheet strength. Institutional behavior over the past quarter reflects a divided outlook. Some large funds have reduced exposure, while others, including the board of the Pension Protection Fund, have reportedly doubled their holdings in early 2026. This divergence suggests that certain institutional investors are beginning to look past the accounting controversy and focus instead on the company's stated goal of generating $10 to $11 billion in revenue in a single upcoming quarter. That would represent nearly a 100% increase from the prior quarter. If achieved, the current forward price-to-earnings ratio of roughly 10 would appear low relative to broader technology sector valuations, which often trade at double or triple that level. This tension between low valuation and elevated regulatory risk explains why SMCI remains one of the most actively debated stocks across investing platforms. From a technical standpoint, the stock appears to be forming a base between $25 and $30. In classical technical analysis, prolonged base building can precede powerful moves. At the same time, there remains a significant gap on the daily chart from the prior sell-off that, over time, the market may attempt to fill. Until the delayed 10K is filed and accepted by the SEC, uncertainty is likely to cap upside potential. Non-compliance remains a major overhang, and markets are typically unwilling to re-rate stocks meaningfully under such conditions. For risk-tolerant investors, however, compliance restoration represents a clear binary catalyst. With millions of shares currently sold short by traders positioning for further downside or even a delisting scenario, formal regulatory resolution could trigger a rapid repricing driven by forced short covering. Looking ahead, the key catalysts are clearly defined. The first is the February earnings report, which will determine whether the projected revenue surge toward $10 billion is materializing. Confirmation would shift the narrative from survival to competitive strength. The second catalyst is the continued expansion of manufacturing operations in Malaysia and Taiwan. Increasing production in lower-cost regions could allow Supermicro to compete more effectively on price without further eroding margins. The third is the ongoing rollout of NVIDIA's Blackwell and Rubin architectures. Supermicro's close engineering collaboration with NVIDIA remains its most significant competitive advantage, positioning the company as a critical infrastructure partner rather than merely a hardware vendor. The broader expectation that the AI boom would lift all participants equally has proven inaccurate. The sector is increasingly characterized by intense competition and operational Darwinism. Supermicro is navigating a self-inflicted governance crisis at precisely the moment when execution quality matters most, creating a complex and fragile investment profile. In summary, the current price of $30 reflects a market that is waiting for clarity before re-engaging on the bullish side. Today's 1.02% gain offers a modest signal of stabilization following prolonged volatility. Expectations for a rapid rebound were undermined by margin compression and accounting delays. Yet the $13 billion backlog for Blackwell Systems underscores the company's underlying engineering strength. Supermicro remains a technically capable organization.